What's up, guys? Mike here. I've been getting a lot of requests from some of you guys to teach you guys how to do options. Well, today I'm going to teach you how to write or sell call options. Pretty much writing covered calls or selling covered calls can be fairly easy to do, and I think pretty much anyone can do it as long as they have 100 shares of a specific stock that they want to sell an option on. So pretty much all you first need is to have 100 shares of a specific stock. For example, if you want to write call options on Apple, you need to own 100 shares of Apple. And if you don't own 100 shares of Apple, then you cannot write any covered calls on Apple. But let's say you do own a stock that's worth $10 and you have 100 shares of that stock. That's about $1,000 of that stock you own. So pretty much you can write a covered call option on that stock. Now let's say that stock, for example, is Google and it's selling for $10 a share. I know Google doesn't go for $10 a share, but in this case, let's say it does go for $10 a share. And you own 100 shares of Google. So pretty much what you're going to do is go to your options in your brokerage and you're going to say, I want to sell 100 shares. That's one contract. Every 100 shares equals to one contract. So you're going to be selling 100 shares as one contract of Google for a set fixed price that is inside the broker's option list. So let's say today is May 21st and the call option expires on May 29th. So you want to sell Google at X date at a certain price, and if it does hit that price, you are forced to sell it. But if it does not hit that price, you do not have to sell it, and the buyer will choose not to execute that price and will not pay you for that option. He will lose his money on something called a premium. When you sell a call option, you are guaranteeing yourself something called a premium. You collect a certain fee upfront for putting your own shares at risk. And that is what a premium is. It's a set fee or price that can go up and down as time fluctuates in the market and dates go by. And once your premium is set and someone buys it at that certain premium, you cannot get any more and you cannot get any less. I think it's going to be a lot more simple if I explain it and show it to you directly inside an app that I use on Robinhood. So with that said, make sure to smash that like button, destroy it. It takes a lot of time to make videos like this, so make sure to smash that like button. So with that said, let's begin. Alright, so I'm going to show you guys exactly how you could write a call options or sell a call option, also known as selling covered calls on Robinhood, the app that I use. This is my brokerage. So pretty much what I did this past week was write a covered call option on a stock known as SPCE or Virgin Galactic Holdings. They currently, what they do is they're trying to make space travel possible. They want to, in the future, charge you $250,000 for a round-trip ticket to go to space and come back to the planet. Also, they just got some government contracts, so they're going to be doing some space travel with government contracts. They also have their own airlines that they build and stuff, making planes and stuff. They got a lot of stuff going on. So let's go back to the covered call options. So pretty much you have to own 100 shares of this company or any company you want to sell a covered call on, no matter what. Without owning 100 shares, you cannot write a covered call option. So I own 100 shares of SPCE. I got it for around $14.92. That's my average price. And it cost me $1,492. That's pretty much 100 times $14.92. So what I did this past week was May 21st. I wrote a call option. Pretty much you just go here where it says trade SPCE options. If you do it in the app, you have to click on it. It's going to say trade options or it's going to say buy or sell options. So on May 21st, I chose my options to write a call option on May 29th. That's the date I wanted my option to expire. And I chose $17 as the strike price on May 29th. It has to hit $17 or more for the person who buys this option to be able to buy my position. And what happens is he had to pay a premium, and the premium that I was collecting was $50. It's $54 now because the stock went up a few cents. It's up about 85 cents from the time I sold this option. So the guy's making now $4. So if he was gonna go and resell this call option to someone else, he would collect $4, which is not a lot of money, obviously, but that's his profit take home, that he could flip this option to someone else and someone else will take over this call option. So you can see this is -1, meaning that I sold a negative 100 shares. That's one contract at $17 strike price, and it has to hit it by May 29th. Now there's two things that you should know about, and that's one of them is risk. And risk can play a huge factor in this. So let's say if this stock goes down below my price, below the price that I bought it was, which was at $14.92. So I could lose money selling this option. Let's say this company goes down from $14.92, it can go all the way down. Let's say I could lose money because this thing could go all the way down to $9. Okay, so I just lost $5 times 100. That's like $500 I just lost if this stock were to go down. So that's the risk I'm taking, that I'm selling this option, because if it goes down I will lose money, but if it goes up I will make money. But at the same time, if it passes $17 I cannot make more than $17, because the guy who bought my option can pay me $17 per share, which is $1,700 he will be paying me, and I get to keep this $50 that I collected from him, the premium. This premium is set. You always get to collect that no matter what. Even if the guy decides not to pay me $17, I get to keep that. So I would make a maximum of $1,750. That's the maximum I could make. And the risk that I'm taking here is if this stock goes all the way to $20, $30, I can only collect up to $17 a share. And this guy could be making bank all the way to, let's say it goes up to $34. He would be doubling his money by May 29th, and I can't do anything about that. So when you sell a covered call option, you want to pray and hope that this option never passes $17. It should hit like $16.99 maximum, so you make your money on the premium, and then once the option expires, you get to collect it and watch it grow some more. Now, I only like to sell weekly options. As you can see, every week you can sell this option and you get to collect more premium. The longer the date of your premium, the more you collect. So if I sold this for 2 weeks straight, I would have been able to collect $101. Probably $4 less now because it went up by $4. But if I would have sold it for 2 weeks, right? Because I sold it on May 21st, and if it would have been mine is only a 1 week option. I highly recommend you guys to do only 1 week options. Even though premiums go up, you can collect more money, but you're also putting yourself at a lot more risks. So the longer the time is, the more risk you're putting yourself at. Because this stock at any time can crash, or this stock at any time can go up a lot, and you could miss out on huge gains. So I only recommend doing 1 week options so you could see and plan for where your stock is going to be going. That way you can make a lot more money because you know where your option is going to be headed, and you can always change your strike price and collect different premiums. So let's say this stock can crash all the way to $13 by May 29th. Obviously, this guy isn't going to pay me $17 a share when the stock is now worth $13. You'd be retarded. I mean, you'd be surprised how many crazy people are out there that they don't ever want to lose, so they'll just say, I want to collect. I don't want to be a loser. I don't want to leave empty-handed. So they'll pay you $17 a share, even though the call option is $13. Even though the stock went to $13. I mean, it'll be very low likely that that will happen. The guy has to be mentally decapitated to do something like that. But there are some stupid people out there that will be triggered, and they want to say, I'm not leaving empty-handed, and they'll pay you that price. I don't know, there's crazy people out there. Okay, you should be happy because you're getting your guaranteed $17 a share, even though it's worth $13. So what you can do is go buy it again at $13. You buy another 100 shares at $13, and then you go repeat and sell it for the next week again, whatever strike price you think it's not going to hit. So when I was selling it, it was around $14.90, which was right here, and I was told that there's a good 78% chance that my option is gonna pay me that $50. Oh, actually, let's go back here to my day. Okay, so I had like a huge percentage for me that it was saying that more likely I'm going to be collecting this guaranteed $50, and it's not gonna hit $17. Okay, so I'm in a very good position. I was trying to guarantee myself free money, and right now, as we can see right now, I am making money, even though the stock is going up, because it is going up. The past week it has been going up. Let's say this is May 1st, 21st that I sold this option on. It has been going up the past few days. It's been going up about $1 a day. On the date that I sold it, it went down a lot. As you can see, it was $14.73, and I sold it around $14.90 something. That's when I sold it, and the whole day I'm like, yeah, go down, but just don't go down enough, because I don't want to lose money either. And then boom, it went up almost a full dollar the next day. So you want your option to expire right under the price that you set it at, and you get to collect that premium, and then you get to go repeat and rinse and repeat. Or you can just go hold the stock and sell it at the price that you feel comfortable, because you think that the stock is going to go crash again. So you have to set your expectations, and you have to know what's going to happen. I mean, you should be looking at your chart. You should always be looking at the last 3 months of this stock. Where is this stock headed? Usually on average, it does hit around 17 to 20 bucks, and it does go down to around 12 to $15. All right, there's a lot of resistance for it to go down all the way to $9. It's not very likely to do that because there's so much resistance around here, as you can see, for this stock. So it's usually around $15, and I felt pretty secured selling it around 17, because on average the stock gets stuck at $15, and that's what's going to happen. So I'm going to make money on this because I'm hoping it does not go up. So let me show you guys another stock so we can have a better idea. All right, so let's see. Let's say you want to do Microsoft, right? Let's say you own 100 shares of Microsoft, and you want to write an option for Microsoft. Now, Microsoft moves a lot between $170 all the way to about $190. And what's going to happen is you're only going to be paid $31 to sell Microsoft at $190. But if you agree to sell it at $187.50, you'll collect $74. But there's a 36% chance that you will lose this stock because the person is more likely to execute it because it has hit $187.50 pretty often. Now, there's also times you should be aware of when to sell an option. Like, for example, when a company is doing earnings, call options can be worth a lot more, sometimes even double the price. So let's say Microsoft was doing earnings on May 29. Okay, this premium, and you want to sell at $187, this $187.50, this premium would not be $74 because the earnings is gonna cause something called IV, implied volatility, to jump a lot. It's gonna cause this premium to go up. So instead of collecting $74 by this date, you might be collecting $160 instead because the premium has gone up. A lot of people now want to buy this option, so it will cause this premium to jump. This premium is going to go up. This premium is going to go up. All these premiums will increase because Microsoft is having their earnings on May 29th. Oh, well, they're not, but I'm just saying, for example, if their earning date was May 29, a premium of all these options would go up by a lot because of implied volatility, which is pretty much a lot more people are rushing in to buy this specific stock because they're expecting their earnings to either be good or bad. So, and also, what I wanted to tell you I missed out on is when you want to sell a call, you have to click this, okay? Make sure to sell. Click sell and make sure it's click on call. Sell, call. Because if you do this, I promise you buying a call is you're actually buying it off someone else. But if you want to sell it, be the seller, you must click on sell a call, all right? Selling a put is a lot more difficult and it can be extremely risky and dangerous and you could lose a ton of money. But selling a call can be extremely profitable. You're lowering your average cost of the stock that you own by just selling a call, and you get to collect more money. So pretty much this is what's been happening when I sold my SPCE. It dropped a lot. The poor guy bought it. Okay, so like this was what was happening. The guy bought it around May 21st. Here it was around $50. It's not showing, but it was around $50, and then as soon as he bought it, it was like going down the ditch. All right, and I was like, hey, what are you doing? Why are you dropping so much? Because the price of the stock is going down. I'm like, I'm losing money too. And then the next day, boom, it went up. Now he's up. He's making money. But see, this is what happened. I sold my contract for $50 on May 21st. This is the price. Right now, the seller could sell this contract to someone else for $54, and he'll take home $4. This is $50 I collected, and it's guaranteed money. And this premium I get to keep no matter what. Whether the strike hits $17 or not, I get to collect this premium on top. So this is what happened when I sold it. I sold it on May 21st, one contract, 100 shares, at 6:34 a.m. my time, which was one of the best times to sell it because it was at its highest peak on May 21st. Anyways, so this is pretty much basic selling options. If you want to make maximum money, I recommend you sell it during earnings dates. Earnings dates are one of the best times to sell options because your option will go up a lot and you can make more money during times of earnings dates for specific stocks. Now, you are putting yourself at risk if this stock goes down, okay? You will be putting yourself at risk if the stock goes down. But you're also missing out on if the stock goes up a lot. If this stock goes up more, you'll be missing out on more gains. So selling a call option can be beneficial. At the same time, it can be risky as well. You have to put your options on the table and tell yourself how much you're willing to lose and how much you're willing to risk. All right, make sure to always do your own research before selling an option, how much you're willing to go risk and how much you're willing to gain. Because I was willing to risk to make $50 because I know on average SPCE trades around $15. All right, so I know I'm gonna be pretty much collecting this $50 guaranteed, and I know my option is gonna be relatively safe because it's more likely to go up than down than me losing money. But at the same time, it's gonna be very hard for this stock to go and hit $17. I'm not saying it's not going to happen, it's not possible, but it is possible for that to happen. And the buyer who buys your option is also risking his money, his premium money. He's paying $50 because he wants to make sure he doesn't spend too much money. He's only willing to risk $50 to wait out by May 29 to see whether this stock will go up or not. If the stock goes up and passes $17, that's great news for him. Okay, because he's gonna execute this trade, and if it's hits $18, he just made $100 extra by executing it. Although he only made $50 profit because he lost $50 in premium, but he also made $50 profit because the stock now is at $18. So this is pretty much basic options, selling call options. It should be on sell call option. It's very simple. The price on buy and call are going to be usually similar. They shouldn't be any different because it's vice versa. You know, someone could be buying your call option and someone like me can be selling this call option. All right. Puts are a lot more riskier. Selling a put can be extremely risky. Make sure to do your research on that. I might do a video on that, but until then, I will not be doing any selling of puts because I know how much money you can lose all of a sudden if it goes the opposite direction that you want it. Thanks again for watching my videos. As always, make sure to smash that like button. Hit it until it turns blue. Make sure to leave a comment below. Also, make sure to subscribe. And make sure to hit that notification bell so YouTube could alert you when my next video comes out. Also, feel free to add me on Instagram. I pretty much post there daily. I might also start posting stocks and times to buy a specific stock. So let's say I was going to buy SPCE. I would post on this day, buy SPCE at $14.90 just because I did it. So if you want to be catching on what stocks that I'm buying and you want to be included in that, make sure to add me on Instagram so you can be following me there as well. Also, if you want 2 free stocks, WeBull is giving 2 free stocks. One for signing up to use their platform and a second one for making a $100 deposit, and they'll give you a second stock for worth up to $1,400. Also, right now, WeBull is having a promotion where if you follow a specific task that they give you, you can be entered into a chance of getting 1 free Google stock. That's included on top of the $1,400 stock and the 2 free stocks that you could get. You can get 1 free Google stock by following the tasks that they give, and it's fairly simple and easy to do. And you could be entered into a chance to get a free stock of Google. Also, if you want another free stock, Robinhood gives a free stock. Link in description below for WeBull and Robinhood. Thanks again for watching my video, and until next time, make money with Mike.